Welcome to Zoom Out. It's June 24, 2025. I'm translating today's stories from Asia, Africa, and around the globe, so you understand how markets impact your daily life, money, and your world. Let's start with the ceasefire in the Middle East. Less than a day after the ceasefire went into effect, Reuters, CNN, Fox News, and other major news outlets are already reporting that both parties have violated the terms of the ceasefire. And they're also reporting that the enriched uranium that was in the facility that the US bombed has been moved to another secure location. So what does this mean? Markets were already responding to the news of the ceasefire. Oil prices went down following the news because the immediate risk to global shipping lanes and energy reserves receded. But with the potential breakdown of the ceasefire, markets will experience some volatility, possibly leading to higher prices for everyday items like gas in the coming days. So what's your zoom out takeaway? Markets love certainty. Even fragile peace is better than escalated war when it comes to oil, trade routes, and monetary policy. This ceasefire gave investors room to breathe, and that optimism lit up equities. Now let's head to Washington, where the Fed Chair Powell is waving a yellow flag. In testimony before Congress, Powell said tariffs are keeping inflation sticky, and that means that the central bank might delay rate cuts. Translation: if consumer prices stay elevated because of trade restrictions, the Fed's hands are tied. Investors had been hoping for a more favorable outcome, especially after the oil price drop. But Powell reminded everyone that global events like the Middle East tensions and policy decisions like tariffs still pose a risk to price stability. Markets pulled back slightly because a July cut is beginning to look more unlikely. Treasury yields dipped and the dollar weakened. So what's your zoom out takeaway? Inflation isn't just a numbers game, it's a policy game. Tariffs and trade tensions are just as powerful as interest rates when it comes to what you're going to end up paying at the grocery store or when you want to go out to eat. Now to South Africa, where the rand is riding a wave of optimism. It strengthened nearly 0.7% today, hitting around 17.76 to the dollar. What's driving it? For one, global investors are feeling slightly more relaxed thanks to eased tensions in the Middle East. And second, the country is gearing up to release key economic indicators this week, specifically job numbers and a business cycle indicator. Why does this matter? A strong rand helps reduce the cost of imports, and it signals that global investors still trust South Africa's macroeconomic fundamentals, at least for now. But there's a flip side. If the data comes in weak, the confidence could fade very quickly. So what's your zoom out takeaway? Africa's biggest economies are more exposed to global risk than ever before. One shift in global mood or one missed data point and capital can shift very fast. Let's hop on down to Asia. Indian markets were glowing green today. Both the Nifty and the Sensex hit 9-month highs, and the Indian rupee firmed up to about 86.10 per dollar. What's behind this rally? One word: oil. India imports more than 80% of its crude, so the sudden drop in oil prices following the Middle East ceasefire immediately lightened inflationary pressure, making things easier for consumers, signaling lower business costs, and giving the central bank more wiggle room to ease up on tight monetary policy. Investors quickly put their money into auto stocks, airline companies, and even consumer goods, sectors that benefit directly when energy prices fall. So what's your zoom out takeaway? India's economy lives and breathes on imported energy. When oil is calm, confidence returns, and so does capital. Finally, a slow burn story with huge long-term impacts. Global central banks are moving away from the US dollar. We're seeing this play out in real time, from Nigeria to Brazil, adding more yuan to their monetary reserves, to Russia going almost dollar-free in trade. It's subtle, but it signals a changing financial power map. According to a new survey by OMFIF, which puts central banks managing about $5 trillion in reserves. Global institutions are planning to cut back on US dollar holdings and load up on gold, euros, and the Chinese yuan. Why is that? Some want to hedge against US political risks and inflation. Others, especially in emerging markets, want more currency flexibility and see diversification as safety. The dollar's share of global reserves is expected to drop from 58% to 52% by 2035. That might not sound like much, but in a world with $12 trillion in reserves, it's significant. So what's your zoom out takeaway? The dollar still dominates, but cracks are forming. And when central banks shift, the ripple effects are global, from trade flows to debt costs to diplomatic power. That's today's global snapshot. What story are you following that you think I should also put on my radar? Please let me know in the comment section. Share this if you found it useful. And don't forget to zoom out. And don't forget to subscribe to keep zooming out with me. My name remains Eniola Lunge, and I'll see you tomorrow.